Okay, please come to the next very important and easy topic called management of payables or management of creditors. Just like you have learned management of receivable, it is management of payable. So what is the meaning of payable? Amount which we owe to the outside parties. Trade payable means liabilities which spontaneously arise because of our business activities like trade creditor. So we will make a phone call. Hello, Adani bhai, send goods. He will send goods to me. I will pay you after 3 months. Okay. Okay. Trade payable is created. I got a finance for 3 months. I don't have to pay for goods today. I will pay after 3 months. So is it a good source of finance? Is trade payable a good source of finance? That is the question. Is it right? It is a good source in some aspect. We will see below advantage and disadvantage. Spontaneous source of finance. It arises in the ordinary course of business. It doesn't require a lot of formalities or documentation or contracts to be entered into. Is it right? Simply by a phone call, an email, a personal visit, and you get credit, which gives you the right to pay after some months, which means for that period of time, the creditor is financing you. Okay, without much legal hassles. If you take the loan from a bank, you'll have to sign lot of documents. You have to give collateral. Bank will put terms and conditions upon you. But here it is relatively comfortable, easy. So what's important to look after your creditor? Slow payment by you may create ill feeling. So just because the creditor has given you credit, that does not mean you will forget him and ignore him. Once you can do it, later on it is difficult to get credit. So you should manage your creditors also properly. If you do not pay on time, what are the repercussions? Ill feeling. Will the creditor like you? Creditor will feel angry about you. Is it right? He will not give you supply on time. Supply will get disturbed. Not only that, bad image. More and more suppliers will go against you. And then it is difficult to buy on credit from other businesses also, because you will have a bad reputation in the market. But creditors are important in our business. We don't have cash for making every payment immediately. We need funds for day-to-day operations. Of course, we can go to bank and take loan. But why not to also tap creditors who is willing to give me credit, and that solves my liquidity problem. Okay. So therefore, they should be managed carefully to enhance your liquidity position. Is trade credit a free of cost source of finance, or there is a cost of availing trade credit? There is a cost. Generally people believe there is no cost because officially he will not say anything. But there is a cost of availing trade credit. What is the cost of availing trade credit? One is differential pricing. Suppose you say I am willing to purchase on cash basis. Tell me amount. Take out your Google Pay. Can pay. He will say, okay, pay 95. But if you say I'll pay after 3 months, will he charge you 95 or 100? So effectively what is happening? You are paying an interest of 5 rupees on 95 rupees for delaying the payment by 3 months, which can be a very high cost. So 5 by 95 for 3 months. So for a year, calculate how much interest you will be paying if you don't pay now but you pay after 3 months. In our example, come on, little fast. 5 by 95 into 12 by 3. Oh my God. So you are actually paying an interest of 21.05% to the creditor. So there is a high cost. You can take a bank loan at 14% and make payment now. Second is loss of goodwill. Suppose it, for any reason you are not able to pay on time. So that will be a loss of goodwill. Suppliers will not deliver to you on time, will not trade with you. Your reputation will be affected. Even the other creditors may not be able to pay you or will not be able to deliver to you on credit. It's always important to maintain good cordial relationship with creditors. If you have bad relationship with creditor, you are at risk of loss of reputation in the market. And the third is, if you have more creditor, you have more administration and accounting hassle. I have seen in many companies, you will also see when you go for audit, there is a separate department which they called payable department. Why? Think of a company like, say, Tata Motors. Okay, because I have done audit in this company, so we have a lot of insider information, but it was long back. Now it is of no use. So they have thousands of creditors, thousands and thousands, because to manufacture truck or car, they require lots of parts used in cars, and everything they don't manufacture. They'll purchase the parts. Okay, and for that there is a creditor, and with different creditor there may be different terms and conditions. Thousands of trucks enter the company every day with input. Okay, then you have to keep a record when was goods received. So they have GRN system, goods received note. Then it goes to respective store. The storekeeper keeps a record. Then it goes to factory. Then when you make the payment, you have to keep a record. And sometimes there can be dispute. Sometimes there can be purchase return. There can be cash discount, credit notes, debit notes. Lot of issues are involved. Okay. In fact, in one company, I had gone for audit. They said, Vinodji, do you want to work with us? I said, no, I am an auditor. I have come on behalf of my audit firm. No, we are willing to offer you a job in payable department. I said, no. They said, how much is your salary? I said, X. They said, we will give you 2X. Payable, headache department. Is it right? Because the creditor or the supplier will be always on your head. Sir, pay the amount. Why are you not paying? First he will talk politely, then aggressively, then abusively. Okay. You can't do anything. You are the employee. Okay. So that is the problem. And then conditions. Sometimes most of the supplier insists for availing the credit facility, the order should be some minimum size or even on regular basis. Means if you want to purchase on credit, minimum quantity you have to order is 100. You have to pay within 10 days. Okay, then some creditor will say you will not supply in other areas also. He'll put restriction. You only supply to customer in your area only. Don't enter into my area. Okay. But if you pay on cash, you are free. Is it right? Yes, sir. So sometimes trade credit will come with T and C, terms and condition attached, which may affect your independence. But what is the disadvantage of not taking credit? In the inflationary environment, you will be the loser if you buy on cash. If you buy on cash, you will be the loser. Suppose on 1st January, a product costs you 100,000 rupees and there is inflation. On 30th June, the price of the same item is 1500 rupees. You will purchase here for 1000, but you will pay on 30th June 1000 only. You will pay on 30th June 1000 only, whereas the market price of that item is 1500 rupees. If you buy on credit, you get the benefit of inflation. Who will bear the inflation loss? The supplier, because you are going to pay to supplier 1000 rupees only. Now the supplier, if he goes to buy the same item to sell to you again, it will cost him more. So indirectly, in an inflationary environment, the debtors benefit, the creditors suffer. So be a debtor in an inflationary environment. Okay. Be a debtor in an inflationary environment. But if you think that I will not be a debtor of anybody, so indirectly there is a loss. Be a debtor in inflationary environment, because you will pay the amount that was already fixed earlier. The creditor will suffer. The creditor loses the purchasing power of money. Okay. Second is, you lose on interest if you pay now. But again, here it depends on whether the creditor gives you interest-free loan or not, or whether he charges you differential price or not. If he says you can pay now or you can pay after 10 days, I am going to charge you 100 rupees only. So what will you do? Now 100. After 10 days also 100. What should you do? You should pay after 10 days. But if you pay now, you are losing interest of 10 days. Yes or no? So sometimes, in case if the creditor is not charging you extra amount, then it is better to take on credit. But if he is charging you extra, then calculate the cost of trade credit and accordingly decide. Okay. And the third is inconvenience. Sometimes it may also cause inconvenience to the supplier if the supplier is geared to the deferred payment. Some supplier will be happy if you make payment in installment, because accordingly their business models are designed. Okay, but this is not a very important disadvantage. I think every supplier will be happy if somebody pays them now. Yes or no? Now just two formulae and two questions. How to calculate the cost of not taking the discount? The following equation can be used to calculate the nominal cost on an annual basis of not taking the discount. Already we have solved questions like this in receivable management also. Same formula. Same formula. Suppose the credit term is 2 by 10, net 45. Suppose credit terms, you can write it also if you want. Suppose credit terms are 2 by 10, net 45. What is the cost of trade credit. What is the cost of trade credit? Suppose credit terms are 2 by 45. What is the cost of trade credit? Now first I'll explain what does it mean. This is now, this is after 10 days, this is 45th day. So the supplier is telling the buyer, if you pay within 10 days, if you pay between 0th day and 10th day, you will get 2% cash discount. Okay. Otherwise, your normal credit period is 45 days. But if you pay after 10th day, you have to pay the full amount. So if you pay here on 45th day, you pay 100. If you pay on 10th day, 98. You pay 98. So therefore, you are actually paying an interest of rupees 2 on 98 for 35 days. You are paying an interest of 2 rupees on 98 rupees for 35 days. So what is the cost of trade credit? So the answer is, cost of trade credit will be equal to 2 rupees we are paying on 100 minus 2, D for discount, D for discount. So basically, simple arithmetic, 2 rupees interest is paid on 98 rupees for a period of 35 days. So in terms of per annum, how this 35 has come, the difference between these two. In credit period is 45 days, but first days are interest free. First 10 days are interest free. And into 100, how much is it? 21.28%. That is the answer. And what is the logic of this formula? The logic of this formula, if you want to know, is simple interest equal to P into R into T. Is it right? So in our example, simple interest is 2, principal is 98, R is missing, so R by 100, and time is 35 days divided by 365 days. So in order to get the value of R, we will just change the position of these numbers. It will become 2 into 365 into 100 and divide by 98 into 35. Can I write like this? You have written the same thing here also. So basically the formula is simplifying your task. If you forget the formula, use simple interest formula and get the value of R. What they have done directly, this is the value of R, nothing else. From that simple interest formula, they have twisted it. Okay. This is how you get to know that if I pay now, I am going to save 21.28% on interest per annum. Right. This is one formula. There is another formula. Now this formula ignores the effect of compounding. This formula ignores the effect of compounding, because sometimes there is interest on interest. Okay. Because you will compute interest for 3 months. Say 100 rupees you invested. Suppose an interest for 3 months is 3 rupees. So it becomes 103 here. Then next period you are going to pay interest on 103. 103 into 3%. 3.09. So the amount becomes 106.09. Then again in the next quarter you are going to pay interest on 106.09 into 3%, 3.1827. So your amount will become 106.09, 109.2727. Then in the fourth quarter, you will pay interest up to 3.2781 something 8, and then you will add with the principal 2727 112.5508.
Yes, sir.
This is compounding effect. Is it right? Now if I say, understand, 3% is the interest for 3 months. What is the interest for 12 months? One way to say is it is 3 into 12 divided by 3, 12% per annum. This ignores compounding. This ignores
Compounding.
But if I say interest is getting compounded also every quarter, so 100 rupees becomes 112.5508. So here my interest rate is 12.5508% if the interest is compounded. If the interest is compounded. So therefore your institute have added one more formula. If the interest is compounded, then the formula becomes 100 upon 100 minus D into 365 upon T minus 1. Is it right? So this formula will be required when there is compounding. This is the formula of compounding. This is the formula for compounding. Both formula will give different answers. The first formula basically ignores compounding. Second formula considers compounding effect. What will you do in the exam? You are a student. Whatever they will ask you, if in doubt, solve by both. Or whatever you learn fast, you can do fast and write an assumption. So there is a small example printed here. What do you mean by D? D means discount. Suppose if discount rate is 6%, D stands for 6. And what is T? T stands for reduction in payment period in days necessary to obtain the early discount on days credit outstanding minus discount period. So in the example 2 by 10 net 45, T will be equal to 45 minus 10, 35. Okay. So now we will solve one example. Don't worry, we will apply this formula in example number 1. Yes. Question number 1. Everybody come to question number 1. Suppose ABC Limited has been offered credit terms for its major supplier 2 by 10 net 45. Oh, same thing. Hence the company has the choice of paying rupees 10 per rupees 100 or to invest 98 for an additional 35 days and eventually pay the supplier rupees 100 per rupees 100. The decision as to whether the discount should be accepted depends on the opportunity cost of investing 98 for 35 days. What should the company do? Source is study material. Is it right? And you write one more line here. What should company do? Question is incomplete. assume that the company can obtain an annual return of 25% on its investment. Assuming that the company can obtain an annual return of 25% on its investment. There is some drafting error in the question. The company has a choice of pay rupees 10 per 100 or to invest rupees 98 for an additional 35 days and eventually pay the supplier rupees 100 per rupees 100. Oh, remove this line, okay? This is the question. What should the company do if you can invest your money at 25%? This line is not properly drafted and it is not required to solve also. Is it right? Now this question is not clear how to compute the implied cost of trade credit. So write down step 1. Implied cost of trade credit is equal to, first write the formula, 100 upon 100 minus D to the power 365 by T minus 1. We are assuming compounding. So 100 minus discount is 2 to the power, what will be T here? T will be 45 minus 10, that is 35. So let us simplify on calculator first. 100 divided by 98. So that is 1.020408 to the power, take 365 divided by 35. 10.42857. Okay, minus 1. Okay. So there is a procedure to solve this type of question. How to solve it, those who know, very good. Those who don't know can understand now. First you take square root of the base number 1.020408 12 times. Just type the number, press square root 12 times. Then you press minus 1. Then you press multiplied by that power 10.42857. Okay, point number 4. You type plus 1 and in the last step you multiply equal to 12 times. Press multiply equal to 12 times. This is a calculator trick. You will get 1.235. Let us say 1.235 minus 1. So approximately 23.5%. Okay, then you also write down alternatively. Give both answer because question is silent. Alternatively, implied cost of trade credit assuming no compounding effect, so now my formula is d upon 100 minus d into 365 by t into 100, 2 by 100 minus 2 into 365 upon 45 minus 10 into 100. Please answer fast. This is simple interest. 35. 45 minus 10.
21.28%.
21.28%. Both way you can present. How much time will it take? Half second, 2 seconds. But some examiner may search for this number in the answer sheet. Some may search for this. Give both. Now the question is, should we pay on 10th day or should we pay on 45 day? If I pay on 10th day, then I will have to pay 9,800 rupees. Is it right? If I pay on 45th day, I'll have to pay 10,000. But 9,800 rupees which I have saved can be invested by us at the return of 25%. Is it right? So we can earn interest for 35 days on 9,800 by delaying the payment. So let us try the evaluation of the proposal. Evaluation of the proposal to accept discount. Evaluation of the proposal to accept discount. Two columns on the right side. One is to refuse discount and the second is to accept discount. So first point A, payment to supplier. If I refuse discount, I'll pay 10,000. If I accept discount, I'll pay 9,800. 10,000 minus 2%. So if I refuse discount, means I will pay on the 45th day. I don't have to pay 9,800 on the 10th day. That 9,800 can be invested for 35 days at the rate of 25%. So write down less return from investing. So under the first column, right now they are not comparable. 10,000 is paid at the end of 45th day. 9,800 is paid at the end of 10th day. So there is an interest component of 35 days which you have to adjust. So less return from investing rupees 9,800 for 35 days. And at what rate you can invest? 25%. Just take on your calculator. So 235. Interest also you will enjoy on your investment on 9800. So what is my net cost? Net payment. Now they are comparable. 9765, 9800. Now they are comparable because I have considered the interest of 35 days also. So what is my advice? Refuse the discount. Because net cost is lower. Without even, you can directly answer also that we are earning 25%, and by paying early I will be earning only 21.28%. So earning 25% is better. So that is also okay. That way also you can write the answer that earning 25% is better than earning 21 point some percentage. One more question will solve. Question number 2 on creditors management. Important, tick mark, please tick mark. The Dole's company purchases raw material on terms 2/10 net 30. Please tick mark. A review of the company's record by the owner Mr. Gautam, but not Adani. Only Gautam revealed that payments are usually made 15 days after purchases. Okay, don't talk. Concentrate on understanding. This is suppose timeline. Don't talk. Year 0 today. This is 10th day, this is 15th day, and this is 30th day. So you can pay on 10th day and pay 98, or you can pay on 30th day and pay 100. But what this company is doing, it is paying on 15th day. So how much it will have to pay?
You have to pay 100.
Because the moment you cross the 10th day deadline, then you don't pay 98, you have to pay 100. Whether you pay on 11th day or then 30th day, you have to pay 100. So what this company should have done?
You have paid on 30th day.
If you don't want to take discount, pay on 30th day. Why are you paying on 15th day when there is no benefit? When asked why the firm did not take advantage of its discount, the accountant, Mr. Rohit, but not Sharma, only Rohit, replied that it cost only 2% for this fund, whereas a bank loan would cost the company 12%. So this is a wrong comparison. Bank will charge you 12% for a year, and the supplier is charging you 2% for a month, not just month, 20 days. So first of all, people who are weak in mathematics, they compare wrong numbers. He is charging 2% for 20 days. Bank is charging 12% per annum. You write here per annum. The question paper setter, sometimes they make such mistake. Analyze what mistake is Rohit making. If the firm could not borrow from the bank and was forced to resort to the use of trade credit fund, what suggestion might be made to Rohit that would reduce the annual interest cost? So then if you are not able to borrow money, then why to pay on 15th day? You should pay on 30th day. Identify. So first you write down Rohit is not right. Write down the answer. Rohit is not right. A 2% cash discount, a 2% cash discount for early payment by 20 days, a 2% cash discount by early payment by 20 days cannot be compared with 12% interest rate per annum. 12% interest rate per annum. Then write down next line. Let us calculate the cost of trade credit to the company. Let us calculate the cost of trade credit to the company when it is paying on 15th day. When it is paying on 15th day. So what will be the answer? On the screen right side, cost of trade credit is 2 rupees by 98. But you are only delaying by how many days? 5 days. For 5 days, for delaying by 5 days, you are paying 2 rupees extra on 98 rupees. So your cost will be in per annum terms 365 divided by 5 into 100.
Oh, 149.
My God. So Rohit is actually paying 149% per annum. 5 days is costing you 2 rupees extra on 98 rupees. So if I convert into per annum, mathematically, ignoring compounding also, then also it is 149%. Okay, now question is, suppose you cannot borrow money from the bank and you have to use the trade credit, what suggestion should be given? Then you pay on 30th day. So write down another note. If Rohit, or if the firm, write down, if the firm cannot borrow from the bank, if the firm cannot borrow from the bank and is forced to use the trade credit, then it should pay on the 30th day. To reduce the interest cost. It should pay on the 30th day to reduce the cost of trade credit. It should pay on 30th day to reduce the cost of trade credit. Next line. The cost of trade credit. When payment is made on 30th day. When payment is made on 30th day is equal to 2 by 98 into 365 upon 30 minus 10. 30 is the total credit period. First 10 days is interest free credit period. Into 100. 37.24%. So you will reduce from 149% per annum to 37.24%. At least you can reduce it substantially. The knowledge of such mathematics helps you to decide when to pay to the trade payable. Second, whether we should avail the cash discount or whether we should not avail the cash discount. Is it right? So, this wonderful chapter is over. These are the 2 questions on this topic. I hope you enjoyed this topic. Yes, thank you.